Good afternoon. Today I want to talk to you about a profit and loss statement. Now, this is a profit and loss statement. I was really surprised at how much a profit and loss statement just scares people. Like it is just this specter of something that you're not supposed to know, or when you do know, it's so complicated, and you only need certain types of people to read it and everything. And there's really nothing to be afraid of. I'm going to break it down a little bit. Just the key components of a profit and loss statement and why you want to have a profit and loss statement if you run a business. Top line. You've heard the term. This is a top line. This is a top line. This is a top line number. This project affects the top line. The top line is revenue. Revenue is end all be all as far as any kind of sales, marketing, any initiative or whatever. This is how you're going to measure it. And it's pretty easy. It's just how much money did you bring in for that particular period. A profit and loss statement is always for a period in time. Usually it's a month. A month, I wouldn't recommend going longer than a month without at least knowing some of these key factors. But it can be a month, and definitely it's told on an annual basis. It's pretty much in any annual report. If you're a public company, if you're a private company, you're still going to put one together. But I'm saying no matter what, if your business is just you, or if your business is 100 people, if it's 5 people, if it's just a cash business or whatever, you need to understand a profit and loss statement. So top line is revenue. Second line, underneath that, you want to back out anything that would be considered a discount. So any coupons that you've given, everything like that, any kind of sales discounts, any kind of chargebacks, people brought something back or you had to discount something. You want to keep that separate because you want to keep an eye on that. So when I talk top line, it's just basically all the gross revenue that came in. If you had to do any discounts, any commissions, any early payment discounts, any kind of refunds or anything like that, take it out and put it separately right up under there, because you want to be able to manage that. And that's the key thing. You want to take things out and put them in buckets so you can manage it better. And that's all it is. It's just a tool to be visible for you to manage your business better. Underneath that, you've got freight. If you're shipping anything, or you're an online business and you ship things wherever, or if you're manufacturing, you make things and you have to ship it to your customer, you want to keep freight in its own bucket too. You want to keep that out. Some people put freight right up underneath. It's okay if you want to put it in a semi-variable cost, and we'll get to what those are in a minute. But you want to keep it separate. You want to make sure you manage your freight, because it's a pretty big number depending on what you're doing. Then like I said, we'll get into costs. Two types of costs: semi-variable and variable. Variable costs are costs that go up or down with revenue. They go up or down with revenue. Case example, let's put one in back at your home. The amount of food you eat in your home is a variable cost, because depending on how many people live in your house, how often you choose to eat, how often you're home, that's going to have a direct effect with how much food you buy, honestly. How much electricity you use. Those are all variable costs, because they have they ebb and flow with usage, basically, in your personal life, or in business we call it with revenue. So variable costs are going to be things like labor. The more money you brought in tends to be probably is going to mean that you have more people working. The more people work, the more hours they're going to do. So that's a directly attributable cost. Things like usage items. So if you're an online retailer and you send things in boxes, the amount of boxes you buy are going to directly be affected by how much revenue you have. If you have a lot of revenue, you're going to want to buy a lot of boxes. So that's an expense that'll be a pretty much a variable cost. Semi-variable costs, however, don't necessarily go up and down with revenue. So, case in point, in your own life, your house note or your car note. Your house note is the same regardless of how many people live in your house. Your rent is going to be the same regardless of if you let everybody come move in or if it's just you, you're going to pay the same. The rent is going to be the same. You may split it differently, but the rent, the cost of it's going to be the same. Same thing with your car note. No matter how much you drive it, no matter what you do with it, the car note's going to be the same. The amount of gas you use, that would be a variable cost. Okay, so semi-variable, variable. What are semi-variable costs in business? Well, semi-variable costs could be your rent for your particular facility. No matter what you do, how much business you run or not, your rent's going to pretty much be the same. It could be something as far as labor goes. If you are a manufacturer, then people in maintenance. You don't necessarily hire maintenance people based on volume. You know, if you run a lot, you'd have to really expand before you'd hire another maintenance person or something like that. So those costs, you have to understand them, and you have to know what those costs are, and you want to keep them separate. So to recap, semi-variable costs are costs that stay constant and don't necessarily move with revenue. Variable costs, revenue directly affects those costs. Okay, the amount of usage, whatever you have, it directly affects those costs. If you had a good month because you ran a lot or because you brought in a lot, you probably had a lot of people working. You probably used a lot more resources than you would have normally, and you have to keep track of whatever those costs are, because if you're going to lose it, right here is where you're going to lose it. In not understanding what your semi-variable or your variable cost, this is where people lose it, right here. Once you minus out your semi-variable, variable costs, you minused out your raw materials, and raw materials should be minused out right under that revenue line. You have your discounts, and then you take out raw materials right out. Raw materials are the basic components, cost of goods sold. Raw materials are your basic components for what you make. So if you're a manufacturer, it's pretty simple. Your basic raw materials to combine, not your usage material, the raw material it takes to make the product. So now that we have minused all that out, raw materials, semi-variable, variable cost, discounts, freight, you're left with a number called EBITDA. EBITDA is a fancy name that we learn in business school. It gets thrown around, by a lot of financial people when evaluating companies. And EBITDA is simply earnings before interest, taxes, depreciation, and amortization. This is probably the truest number that you can get as far as the health of a company. So much so that if you sell your company, the value of your company is based on a multiplier of EBITDA. And particular industries have standard multipliers. You have certain industries, businesses are going for five times. So if your EBITDA is $1 million a year, that's what you make before earnings, before interest, taxes, depreciation, and amortization, then and you have a 5 times multiplier, then the value of your business is $5 million. And nobody's going to pay you more than that unless you can improve your EBITDA. Conversely, any improvement you make to EBITDA directly affects the value of your company. So being able to manage your costs, the better you manage your costs, the more that goes to that EBITDA line. It's basically earnings before interest, taxes, depreciation, and amortization. Interest on loans needs to be taken out. You have it on separate. Interest rates fluctuate up and down. You can have variable interest rates. You can refi the loan or something like that. You want to make that a different bucket. Taxes, you want to keep that as a different bucket, but taxes go up and down based on your tax liability. And your tax liability, if you have a good accountant, is something that will always be scrutinized to maintain and leverage there. Depreciation is a number that the government and the IRS gives you to be able to levelize major purchases. You spend $1 million for a machine in 2017, you don't want to take the tax hit for that. You don't want to take the tax hit or the accounting hit for that particular machine. So what you're allowed to do is you're allowed to depreciate that machine over 7 years on a monthly basis. and that's what you end up paying taxes on. And it stimulates purchasing and selling and production of new major equipment and that kind of thing. So it's kind of a smart thing to do. And amortization is basically how things are amortized over time. So you can take things like buildings and that kind of thing, and you amortize it over time. But again, these aren't real numbers; these are just accounting numbers. That's why EBITDA is a majorly important number for you to pay attention to. After you take out EBITDA, you're left with net income, profit, the bottom line, and that is the bottom line of a product of a profit and loss statement or a P&L statement. The bottom line is net income. The top line is revenue. That simple. Hopefully that didn't seem scary. Check us out on YouTube, on Facebook, and on Twitter at JK Trust LLC, at JK Trust LLC. Go to our website, www.jktrust.net. Again, good to see everybody. Took a couple weeks off, with the kids, everything. I hope everybody's having a great summer. Out here in the San Fernando Valley, it is hot. So wherever you are, I hope you're enjoying it, and go cool off somewhere. Thanks. Bye.